So this is Chapter 13, Non-Taxable Exchanges. So, a non-taxable exchange versus a tax-free exchange. A non-taxable exchange means realized gain or loss are currently not recognized. Recognition is postponed to a future date. Basis, potential depreciation, recapture, and holding period carry over. A tax-free exchange means the non-recognition of the gain is permanent. If property is exchanged for like-kind property, now remember, after 2018, this only applies to real property. Before, it used to apply to similar sales of other items like equipment. If the property is held for the production and use of a trade or business or as an investment, then no gain or loss is recognized if exchanged for like-kind property. Real property assets held for trade or business and real property assets held for the production of income. Note, real property personal assets, such as personal residence, do not qualify for like-kind exchange treatment. However, real personal property, so your personal property, is afforded special tax treatment. First of all, it's deductible of the mortgage interest in real estate on Schedule A, and the gain is exempt up to $250,000 for a single individual and up to $500,000 for married filing joint under the IRC 121. The gain is exempt. What does Section 1031 not apply to? So personal use properties, inventories, partnership interests, which is general partnership, limited partnership, LLCs, securities, stocks, bonds, notes, interest in partnerships, certificates of trust, goodwill, and any other real property. Interpretive very broadly to promote the highest and best use. When we're talking about like kind, we're talking about the same in nature and character. In order for this to work, the real estate must be improved or unimproved. So it could be land. You could exchange a rental property for unimproved land, technically, if you were going to build on it or do something and try to make income on it. Or you could exchange, it needs to be, in order to qualify, improved or unimproved. U.S. realty for foreign does not qualify. Foreign for foreign does qualify. Daryl inherited a raw piece of land from his great-grandfather and decided to convert the property into an income-producing property. He later traded his raw land for an apartment building of equivalent value. Since he engaged in exchange of a like-kind property, realty for realty, the gain realized on the raw land as of the date of the sale will be deferred into the apartment building under Section 1031. Now just remember, there's all kinds of restrictions and rules around the 1031 to make sure it's executed properly based for the IRS. Blanche owns a hotel in Salem, Massachusetts. She wanted to purchase her own real estate abroad and had an opportunity arise for her to purchase the Killarney Hotel in Ireland. Both properties are worth the same amount of money, so Blanche trades her hotel in Salem for a hotel in Killarney. Despite the fact that these both are used in the trade or business or production of income, you cannot exchange U.S. for foreign real estate and exempt the gain and defer the gain. Blanche must recognize the gain in the year that she transfers the Salem hotel. The proceeds from the sale of the original property must be held. So in order for this to happen, non-simultaneous taxable exchange. The proceeds from the sale must be held by an escrow agent. You cannot receive any of the proceeds by property of the owner wishing to engage in a 1031. A replacement property must be identified within 45 days of the sale, and the closing on the replacement property must take place by the earlier of 180 days from the sale of the original property, or the due date including extensions of the tax return for the year the original property was sold. So if the original property is sold in 23, 180 days from the original date, or you have until April 15th plus extensions, so they must close either 180 days or by October 15th, 2024. If it's a related party, deferred gain is recognized in the year of disposition. If the exchange occurs between two related party disposes of the property within 2 years, then gain must be recognized. It does not apply if either party dies before the sale, and it does not apply if tax avoidance is not the motivation. Related parties include brothers and sisters, half and whole or adopted, spouses, which results in a carryover basis, ancestors, descendant, and controlled corporations, which means you have more than 50% equity. So example 1, Dallas, owner of a large apartment building, engaged in a like-kind exchange with his son, Cade, who owned a smaller rental building. Part of the gain on Dallas's large apartment was deferred in a like-kind exchange under Section 1031 into the newer, smaller property. Cade announced that he sold the apartment building he received in the like-kind exchange. Since Cade was a related party and disposed of the property received in the like-kind exchange within 2 years of the transfer, Dallas must recognize any remaining gain realized on the transfer of the apartment building in that same year. So if you're going to do this with a related party, make sure they don't sell that within 2 years of the 1031 that you did with a related party. Sophia, 55, owns 55% of equity interest in Sybil Corporation. Sophia and Sybil agree to transact a like-kind exchange of a high-rise condo by Sybil for a warehouse owned by Sophia. Sophia subsequently sells the high-rise condo 18 months later. Sybil will recognize the deferred gain on the transfer of the high-rise. Since Sophia is a related party, a taxpayer who owns more than 50% equity interest in the corporation, and the property received in like kind was sold within 2 years. If property is changed but the investment solution stays the same and nothing was taken out, then 1031 allows deferral of the gain. So an example. The current property you have, the fair market value is $450,000. Adjusted basis, or AB, is $130,000. So you technically have a deferred gain, $450 minus $130, of $320,000, and your basis is $130. In the new property you exchange for, it has a fair market value of $600,000, and the question mark is, what is the adjusted basis in order for your new basis to be 280? So the answer is 150. So 130, 280 minus 130 equals 150. If there's boot, as we call it, cash or other non-like-kind property at fair market value received in a like-kind exchange, boot includes debt relief, so you're giving the mortgage away. The tax consequences. Gain is recognized to the extent of boot received. Losses are not recognized on exchanges involving boot. Instead, a basis reduction occurs. The transferee of the property classified as boot may recognize the gain or reduce the basis as a result of a realized loss. Trading down. The current property, go back to the example, is $450 fair market value. Adjusted basis is $130. Deferred gain currently is $320,000. You exchange it for a new property worth $350,000 with a deferred gain of $220,000. So if you withdrew $100,000, you got $100,000 cash, then you must recognize that. In order for this transaction to be equal or an exchange, there must have been boot received. Here's an example with actual people, which I think is much easier to follow. Riley and Ryan engage in a like-kind exchange. Riley transfers real estate with a fair market value of $400,000 and an adjusted basis of $250,000 to Ryan. Ryan transfers real estate worth $500,000 and an adjusted basis of $200,000 plus a mortgage on the property to Riley. Including the mortgage, the exchange is an equivalent economic transfer. The following slides will illustrate the tax consequences for both Riley and Ryan. So let's look at Riley's transaction. Old property is $400,000. The basis is $250,000. Potential gain is $100,000. The new property is $500,000. The basis is $350,000. And the $500,000 is because, let's go back to the example, Ryan transfers real estate of $500,000 with an adjusted basis and the mortgage. So since the mortgage is added, Riley adds the mortgage to the old basis. So old basis was $250, new basis is $250 plus the mortgage because Riley has to pay the mortgage. So that adds to basis. On Ryan's exchange, Ryan changed the old property, $500,000, with a basis of $200 and a potential gain of $300, in exchange for a $400,000 fair market value, with a new basis of $200,000, and Ryan recognizes boot of $100,000. So basis remains the same, and Ryan must recognize a gain of $100,000, which is the debt relief. Losses on the exchange. So 10 years ago, Dorothy purchases a residential rental property for $200,000. She has taken $70,000 in depreciation deduction over the holding period and has an adjusted basis of $130,000. Fair market value is $120,000. Dorothy engages in a Section 1031 for a new property worth $100,000 and receives $20,000 in cash. So let's look at this transaction. Because this is a loss, the boot is different. Fair market value is $120,000, basis was $130,000, potential loss is $10,000. The new one, fair market value is $100,000, new basis, so because there's a loss, we're going to take the new basis and we're going to subtract the $20,000 cash. So the new basis is $110,000, leaving with a potential loss of $10,000. So because you got the property and you received the cash, your potential loss is still the $10,000, and basis is reduced by boot. Section 1231 provides the following basis calculation for like-kind exchanges. So what's the basis? Basis of any like-kind property transferred, plus the basis of any boot given, plus any gain recognized, minus the fair market value of boot received, minus a loss recognized. For a validity check, the basis of like-kind of property can also be calculated using the following. Fair market value of like-kind property received minus postponed gain or plus postponed losses. If the basis has properly been calculated with each formula, the result will be the same. You definitely want to take note, snap a picture, look at this. You definitely want to know this formula. So, if it's a 1033, which is different than a 1031, this is an involuntary conversion. This could be because of a natural disaster, theft, seizure, condemnation, or sale or exchange under threat of condemnation of the property. A voluntary act by a taxpayer is not an involuntary conversion. Permits does not require non-taxable treatment of gains if the amount of the reinvestment in replacement property equals or exceeds the amount realized. That's usually associated with eminent domain. So eminent domain is where the government can seize your property. Replacement property must be similar in function or used as an involuntary converted property. Acquired within a specific time period, the time period starts on the date on which the involuntary conversion or threat of government action occurs. The time period ends a specific number of years from the end of the year in which the realization of the first occurrence. So for natural disasters, it's 2 years, government action is 3 years, and presently declared disaster areas is 4 years. Direct versus indirect conversions. A direct conversion occurs when converted property is replaced instead of purchased. Non-recognition treatment is mandatory. The basis and holding period in the replacement property is the same as the converted property. To avoid recognition, fail the test of time. So recognition happens. If you fail the test of time, you can avoid recognition. So some people fail things on purpose to execute something happening. An indirect conversion is when non-recognition treatment is elective. The gain recognized to the extent of the amount realized, usually insurance proceeds, exceed investment in replacement property. The basis in replacement property is cost less deferred gain. The holding period includes that of the converted property. Jules owns a vacation home in Avalon, New Jersey. It was destroyed by storm surge on August 1st. She believes Congress will increase capital gains rates in the near future due to pressing budget concerns. Instead of buying a replacement property, Jules waits until the statutory period expires, which triggers a recognition of gain, assuming she pays the capital gains rates of 15%. If Congress does raise the capital gains rates, as Jews suspected, to 25%, she would have a significant savings by forcing the capital gain instead of the non-taxable exchange, and she did that to take advantage. So that's a tax planning strategy. Now, you can't plan specifically on your house being destroyed in a natural disaster area, but you can plan to do something if you think tax rates are increasing. Gains from casualty theft or condemnation may be deferred as involuntary or excluded as a sale of residence if it's your personal residence. So, insurance policies. So, they definitely asked us on the CFP exam. So, what type of insurance? If you have a life insurance contract, you may exchange it for a life insurance or another modified endowment contract, a life insurance policy, a modified endowment, or an annuity. So, life insurance can be exchanged for all three. Modified endowment cannot be exchanged for life insurance with non-recognition, but it can be exchanged for a modified endowment and an annuity. And finally, the annuity can be exchanged for an annuity. When an insurance product that would be tax-free is exchanged for an insurance product that creates ordinary income, there is no immediate recognition of gain. Johnny owns a life insurance policy he no longer needs. He exchanges that policy for an annuity. The exchange of the policy will not cause a gain recognition since Johnny is exchanging a tax-free contract for an ordinary income contract. When insurance products that create ordinary income is exchanged for an insurance product that would be tax-free, there's an immediate recognition of gain. Johnny owns an annuity contract. He decides he does not need the annuity contract to provide retirement income and converts the annuity that is now worth $100,000. He paid $30,000 on the annuity. It's now worth $100,000. Johnny cannot avoid the $70,000 gain recognition when he surrenders the annuity to purchase the life insurance because the life insurance is tax-free. On Section 1036, corporate recapitalization, it typically involves the restructuring of equity interests from voting common stock to non-voting common stock in the same corporation. A shareholder does not recognize a gain on recapitalization. Common stock is exchanged for common stock in the same corporation and preferred for the preferred. In a 1038 reacquisition of real estate, the repossession of property subject to an installment note will not cause recognition of the remaining deferred gain. It's attractive for older generation family members that take a security interest in property sold to younger family members under the installment agreement method. For a 1041 transfer between spouses, all transfers between spouses and incident to a divorce result in a carryover basis to the transferee and a carryover holding period. Ross and Rachel, that's so sad, are getting a divorce. As part of the divorce settlement, Rachel receives the vacation home worth $800,000 that the couple paid $300,000 for many years ago. Rachel is the transferee, and her basis in the home is $300,000. If she sells it, she will recognize a gain to the extent of any proceeds that exceed this amount. If we're talking about principal residence, I might have mentioned this earlier, a gain can be exempt if you sell your principal home. It must be used as a principal residence for 2 out of the last 5 years. A 1-year stay in a nursing home counts towards the 2-year requirement. An exclusion can only be used once every 2 years. So, and the exclusion is $250 for everybody but married filing joint, which is $500. A Section 121 exemption rules for spouses. For married filing joint, the $250 exemption is increased to $500 if either spouse meets the 2-year ownership requirement and both spouses meet the 2-year use requirement, and neither spouse has excluded a gain from a prior sale or exchange of another principal residence within 2 years. So one of the places that we would watch out for this is like when someone gets remarried and they're going to buy a different house, if they sold houses, etc., this might come into play. So you want to make sure there's good timing. If at all, you can do that. Arturo and Katrina recently married. About 4 years ago, prior to their marriage, Arturo purchased a townhouse in which the couple used as their residence after they were married, knowing that they would purchase a new residence when they started their family. Arturo never added Katrina's name to the title or property. 3 years after they were married, they decided to start a family and look for a new home. When the townhouse sold, Arturo and Katrina's may exclude up to $500,000 of the gain from the sale, since Arturo met the ownership test. He owned the principal residence for 2 years, and both Arturo and Katrina met the use test. It was their residence for 2 out of the last 5 years. A taxpayer can qualify for a reduced exclusion if the sale is due to change in employment, change in health, or other unforeseen circumstances. The exclusion is based on the relationship between the last sale and the current sale. The max exclusion amount, let's say $250, times the number of qualifying months, 18 months out of the 24, would be a partial exclusion. If a home is used as a taxpayer's principal residence was acquired in a like-kind exchange within 5 years of the sale, the Section 121 is not available. So if you like-kind exchange and then you call it your principal residence, 121 does not shield you from recapture. So in life insurance, death benefits. So one of the reasons people buy life insurance to protect themselves, but the other reason is that it is not subject to income tax. Unless the policy has been transferred for consideration, which means transferred for value, like a cash payout. Exceptions to the transfer rule are the policy is transferred to the insured, the corporation in which the insured is a shareholder, a partnership in which the insured is a partner, the partnership of the insured, or someone that takes the transfer as basis. If you borrow against the life insurance policy, so this is why whole life policies are sold, right, from a financial planning perspective. In theory, you can borrow against the life insurance policy in retirement, and that will not trigger taxable income. Therefore, it remains in force for the lifetime of the insured as long as you can borrow. If you surrender, then it is treated as taxable as part of a distribution upon surrender and subject to income tax. A Roth IRA or Roth account or 401k, 403b, or governmental 457b. So what are the characteristics? Contributions are taxable, which means you're funding your retirement with after-tax dollars. Distributions are tax-free. If the distribution is qualified, then distributions that are not qualified are taxable on a pro rata basis. The account must exist for 5 years, and distributions after 59 and a half, death or disability, also first-time home purchases up to $10,000 are for Roth IRAs only. So we're going to do, I posted a spreadsheet, but I'm going to go back to this like-kind exchange here. Sorry for the scrolling. Okay, so let's talk about Ryan. So Ryan has, you can pull up this spreadsheet on Excel, but I'm just going to make this. So Ryan has, make this a little smaller. So on this spreadsheet, it is a walkthrough of how to calculate the gain recognized and the gain realized and the gain recognized on a like-kind exchange. So example, Ryan exchanges an old property for $500,000 with a new property of $400,000. Fair market value of like-kind property received, so $400,000. Oops, I need another 0. You can type in here, the formulas are already set up and you can access this in Excel. Plus any net value of like-kind property received, unlike. So he got rid of a mortgage that was boot. What was his basis in the property exchange? $200,000. Oops, extra 0 here. So because he has a $300,000 gain and $100,000 is the boot, which is the mortgage he's getting rid of, then the gain realized is 300, but the gain recognized is the lesser, right? So the boot. So his new basis in the property is 200,000, and his boot recognition is 100,000. So I will post this Excel spreadsheet, and you can walk through it, and it gives you, there's places to type in, and then the formulas will be driven everywhere, and you can just type in to calculate gain realized and gain recognized on like-kind exchanges.